Yes.
Maybe it'll be a good idea. I mean, if you guys are up for it, you don't know each other because you're from different cohorts. So in case you're interested, maybe you can type in the chat window, maybe your name, where you're from, what your business is about, and if in case any one of you wants to connect with each other or reach out, it may be an option for people just to have this sort of networking going on the side. I'll be seeing most of you on 11th anyway, hopefully. So a lot of you will be coming in on 11th of May, isn't it? So it'll be good to catch up then. But other than that, yeah, in case if you're interested, just pop in the chat box what your business does, and if anybody else needs your help or wants to connect with you, then they can reach out to you. All right, so we're almost ready to start. I just wanted to thank you all for joining me today. We're going to dig into some real cool and important stuff about 8 keys to maximize your company value. That's what we're going to talk about today. I hope you're on the right webinar. Just making sure that we are all, in here to talk about the business value. And while we're doing this is the first time I'm using Microsoft Teams webinar option. So I'm not sure how the interface looks at your end, but I think on the right hand side you can see the chat window, and you should be able to type in there and connect or ask any questions. So, if you have any questions or if you want to share something, please put it in the chat function there. I've got Kirti here with me, who will be helping me with managing the chat, and we're going to be sort of taking some questions as we go along. Otherwise, what I'll do is we'll take all the questions in the end. We'll keep around 15-20 minutes in the end to cover the questions. So whatever you have, I can see Ben, Clayton, Clive, Dan, Faye's also there, Gavin, Gemma, good to see you all. Greg is here. Oh my God. John is there. Yeah, Constantinos, Mark, Prashant, Richard. Yeah, Tim, Suraj. Yeah, welcome to all of you. Great to have you here. It's going to be a fun session today. I'm going to share my screen first. You should be able to see my screen now. Right, so like I said, we're going to talk about the 8 drivers of your company's value. And I'll introduce you to the drivers, and I will also talk about the owner's matrix. I think that concept is equally important. Just to lay down some ground rules, like I said, I've muted all of you, but if you have something to share, please put in the chat box and I will unmute you and we can kind of have a conversation. I'll try and answer as many questions as I can. Like I said, Kirti is helping me manage the chat box. We'll be running for about an hour 15 minutes, and we'll keep the last 15 minutes to answer any of the questions that you may have. Now, most of you are part of Brunel community. Some of you, maybe a few of you, are not part of the Brunel community. So just to sort of introduce myself, a little bit about me. I'm Andy. I'm a business coach, and I work with SME leaders on growth strategy and exit strategy. I run a business coaching firm and called Business Results Coach, based in West London. And I'm also involved with Brunel in delivering the growth focused programs to SME leaders. Normally, my clients come from industries like retail, both online and offline, hospitality, media, automotive, IT, accounting, marketing agencies, estate agencies, just to name a few. And prior to that, I've owned and sold business. I managed businesses in leadership role. And I worked in sectors like retail, petroleum, hospitality, training, etc. So before we get started, just want to sort of get some sharing going here. So we're going to be using Menti. I'm sure most of you are familiar with the Menti that we use. So if you are not, just take your phone and scan this QR code. You should be able to join me on the presentation. Some of the things that we will be sharing, or I would ask some questions, which you can answer, and we can all see the answers here. So if you have a phone, or if you have your tablet, just go to menti.com and you can then enter the code or just scan the QR code. If you do that, you should be able to join the presentation as we go along in this presentation. So what we want to talk about first of all is what would you like to get out of today's session? So if you just type in Menti, what is it that you would like to talk about or learn more about from today's session? So what next steps, mindset, considerations? Interesting. What else? Is everybody able to access the Menti?
No,
Right.
I haven't, sorry.
Are you having trouble? So if you go to menti.com and in your browser on your phone or your tablet, just type menti.com and the code is on top 3508786. Sorry, 7868. Yeah. So plan exit strategy. Great. Some good ideas, considerations, what to plan for, headspace to think. Yeah, keep going, guys. Keep going. We are going to be talking about all of this. So if you share what you're looking to get out, I'll try and make sure that I cover that. Exit readiness. Yeah, that's a good one. Plan, right types of behaviors. Yeah, good one. Expertise, guidance, how others can help. Interesting, precise tips. Yeah, we will be talking about a lot of tips today. Team preparation. Yeah, we'll cover that a little bit. How to sell my business. Good one. What else? Scale up. Yeah, scale up is part of this. We won't be digging too much into scaling up, but yeah, scale up is linked to this. Some ideas, the 8 keys. Yeah, that's a good one. The 8 keys. That's what the webinar is all about. 8 keys, isn't it? Right. OK. What else? Value my business. Yeah, I'll give you some ideas on how we value the business and maybe share some next steps on what you can do from here on. So value business. What else is there? Ideas for future. Good stuff. Scalability, mindset in the middle, which is the most important bit. So yeah, so we're going to be talking about all of that. So while we do this, the points that you've put there, I just want to outline some of the agenda here. So these are the 8 keys that I'm going to be going through with you. So and I'm going to go through each one of them in detail with you so that you can understand what we mean or how these are relevant to your business or your organization and what you can do in future about them. So what is it that you can do to improve the scores or your performance in these areas to improve your valuation score? But that is what is linked. So before we start, I wanted to share with you a story, and I think it'll be good to share a story. I just want to tell you a little bit about a person called Stephanie Breedlove. If you can keep yourself on mute, that'll be great. Unless you're speaking, unmute yourself, but otherwise keep yourself on mute, please, everybody. So this is a really interesting story. So Stephanie is a mom. She's got 2 kids, and the kids are not kids anymore. They are now 25 and 27. But when they were first born, she was upcoming, successful an accountant at the big 4 accounting firm in US, and she wanted to stay in her career. She was on track to become a partner, but she also kind of wanted to take care of the kids, and she was looking for a nanny to do that because she couldn't leave the workforce. And she said, I'm going to hire a nanny to take care of the kids. And then she started to figure out, the hoops that you've got to jump through to get your nanny paid, because for most people, especially accountants, you want to pay them legitimately. But as it turns out, it's easier said than done, because in US, IRS makes you go through all these hoops to get somebody set up on payroll. And Breedlove thought, well, this is crazy. It's way too complicated, way too hard to set up somebody on payroll. And she was just having a conversation with her husband one evening, and she said, you know what, we should start a company that just does the payroll, who have a nanny to pay. And then she went back and forth with her husband a few times, and then finally they agreed to do it. So they built this company called Breedlove and Associates. And like most small businesses in the early days, she went to her friends, spoke to people in her circle. So all the moms group and all her family and people in Austin, Texas. And she said, you know what, if you got nanny to pay, let me kind of help you, pay them for you. I can set them on payroll and, I can get you started. But soon she reached a saturation point. Where she's spoken to all her friends and family, and most people that she knew knew about Breedlove and Associates. And by that time, she reached about 300K in revenue. So she's exhausted her circle, and that's when she realizes that what do I need to do next? So in that case, she was faced with choice. So in terms of what is it that she can do next? And when she was looking at the kind of taking the next step, what she was trying to do is look at one option is to sell more stuff to the parents that she has. And she, kind of make more sale with the people that she already has in the database and bring them to sort of buy more from her in that case. And when she was looking at this and trying to make those choices, most of the people that she spoke with, the consultants that she spoke with, or the advice that she got, or the guidance she got, everybody told her, yeah, you should be selling more to the people you already have, because these are the people who can use more services. They may need other services from you. So they may need something in terms of taking care of the lawn or getting some meals or something else. You can do that. Other option for her was to look at find more parents who needed a nanny. So it was kind of a question that she needed to sort of answer or figure out what is it to do to expand further, but she thought my original idea was to do payroll for parents who had nanny to pay, because that's the pain point. And that is also, I think, my differentiation. And I can do that better than anybody else. It was much more difficult road to take for her because she's already saturated her existing network. But to her credit, she decided to double down, doing one thing better than anybody else. And in this case, it was payroll for parents who had enough money to pay. Well, jump forward about 25 years, and Breedlove and Associates is generating about $9 million in revenue at the back of about 10,000 customers. So we are over 5 years now, and she's built it to 9 million in revenue. So if you're doing the math at home in, or in your office, wherever you are, it's not Tesla, it's not Amazon, or it's not Google. It's a relatively slow growth company. They just kind of put their head down and worked for 25 years. They got to 9 million in revenue, 10,000 customers. Now the kids have left the house, and Stephanie thought, you know what? I want to go and do something else. And she decided to sell her business. And she looked at the horizon and, who are the people who would be willing to buy her business. And she discovered a company called Care.com. Now, what does Care.com do? They are an online portal, a website, which gives you access to 5-star nannies or babysitters. Effectively, you put in your postcode and, on the website, and it'll give you all the 5-star rated nannies and babysitters in your local geography. And at that time, Care.com had about 7 million parents who were subscribers to Care.com. Think about that for a second. That's 7 million parents who had nanny to pay. So Breedlove, in her own business, just had 10,000 customers. So she went to Care.com and said, why don't you buy my company? All of your 7 million subscribers need to pay their babysitter, their nanny, and we can make it easy. She said, look, if 1% of your customers buy my payroll services, that's 70,000 customers. That's, a business 7 times straight away. The size that we are today, it took us 25 years to get to 9 million. You could get to 70 million, almost 70 million virtually overnight. And that's just 1% I'm talking about. Imagine what happens if you convert 2%. And she made the case. And she sold the company. Long story short, Stephanie Breedlove sold a little $9 million company for $54 million. Now, if you know anything about business valuation, that's astronomical. Usually companies like this, which are trading, like that, they sell for a multiple of EBITDA or profit. Breedlove sold her company for a multiple of revenue, not just a small multiple, but 6 times her revenue. How did she do that? Well, it was not doing what everybody told her to do, which was to focus on growing as fast as she possibly could by cross-selling a lot of additional products and services to her existing customer base. The way Stephanie did it was focusing on something we call monopoly control. And it is one of the 8 key drivers, which I'm going to talk about today. But I just wanted to share the story before we get started. So these are the 8 drivers that we're going to cover today. And the financial performance, growth potential, Switzerland structure, valuation seesaw, recurring revenue, monopoly control, customer satisfaction, and hub and spoke. So when you look at these, 8 key drivers, these are the ones which influence the buyer's decision on what multiple they would be willing to pay for your business when they're analyzing or when they're evaluating this whole process. What we're going to do is we're going to look at each of these drivers, and I'm going to explain to you how these drivers impact your company's value. And then we'll discuss on how we can improve your performance on each of these factors. So let's go straight in. The first driver is financial performance. So when we say financial performance, it basically covers, the financial side of the business, which is turnover, profitability, cash flow, balance sheet, all the numbers that they would look at before they make a decision. Now, when we look at it from the buyer's perspective, or there are some questions that a buyer would have before they make that judgment. Now, I know some of you may think that I have no intention of selling, which is okay if you want to pass it on to somebody, next generation, kids, or build it for next decades, like Rob was talking about. What we need to do here is look at the business as a buyer would. What is a buyer buying? Because if we look at it from that perspective, we can build a better business. So what is a buyer buying? A buyer is buying a business that can still grow even after the owner leaves or even after you are out of the picture. So looking at the eyes of, looking at the business through the eyes of an acquirer, there are 2 main things which come out. First thing is, how much profit will your company generate in the future? Because that's the decision, or that's the kind of question they have in their head. And secondly, what they want to know is how reliable those estimates are. So what do they do is they look at your financial performance for last, few weeks, few months, few years to arrive at some sort of calculation or make a judgment on what the business will do in future. And what they use to calculate that is something called discounted cash flow. I'm sure you've heard of discounted cash flow before. If you've not, I'm just going to quickly try and explain it to you. Discounted cash flow is used to arrive at the current value of the business based on future earnings. So you discount the future cash flow, right? So take an example here. So you may have looked at a business where basically a business which will do about £1 million turnover next year. Now, if you want 15% return on that investment, you would discount it by 15%. Right, so it's linked to how the multiples work. You must have heard about the multiples of profits. So multiples, are derived from discounted cash flow. So it's important to understand that multiples, they don't live in a vacuum. Sophisticated buyers, they do calculations in the background to arrive at a multiple that they're willing to pay for your business. And that valuation technique is called discounted cash flow. So like in this case, as an example, if you want 15% return on your investment and you expect the business to generate a profit for 1 million, what you would do is you would be willing to pay 869,000 for that asset in a year's time. So that is what you would be willing to pay. It's a simple calculation. Don't worry too much about the calculation. Don't worry too much about the math. Just understand the principle that we are covering here. Now, when we are looking at the business, we're not looking at just 1 year of profit. We're looking at profit multiple years, right? So in this case, in second year, you will be looking at a value of 756,000, because what happens in this case, you will have to wait for 2 years to realize that profit. So you're going to discount it further 15%. Right? And that is how you calculate the discounted value of the business based on the future earnings or estimated future earnings of the business. And if you take it further, if you look at it 10 years, for example, because normally discounted cash flow, they calculate over a period of 10 years. So you can see here, you're willing to pay about 5 million for this business. And when we look at this particular example here,
the sound has cut off. The sound has cut off.
You have got on a mute. Andy, I think you have gone on a mute here.
Sorry, can you hear me?
Yes, now we can hear you. Thank you.
Sorry, thank you. Right, so when you look at this example here, you can see there here, you would be willing to pay about 5 million for this business, which basically means you're willing to pay a multiple of 5, which is the current profit, or the profit is, per year is 1 million. You're willing to pay a multiple of about 5. And that is what the math behind the multiple is. But this math may be complicated, and it can become even more complicated when buyers, kind of work on this. So, but I want you to focus on the process or the principle behind it. Don't worry too much about the math, because the buyer will do their own math when they're doing it. Now, when we look at SMEs or most SMEs, a 15% discounted is good for businesses which have, quite a good certainty of achieving those targets. For most SMEs, they get penalized even more because their profits are not as reliable or much less reliable. For an SME which has choppy or unpredictable results, an acquirer will be more skeptical about their future earnings. So what happens in that case, then they would be discounting at a much higher rate. And you can see in this example, let's say if we take an example of a 50% discount rate. And if we look at this example here, and if we take it further, you look at it, if you discount it by 50%, the valuation of the business is about 1.9 million. So you see the difference in both the situations, or both the kind of situations that we have. If you project it over 10 years, if you apply 50% discount, you get a multiple of about 1.9 or 2 times. If you discount it by 15%, your multiple is about 5. Now, math may be complicated, but what I want you to understand is that your discount rate is impacted on how reliable your future stream of profit is. So less reliable your future stream of profit, the higher the discount rate. The higher the discount rate, less valuable your company is. So when we're looking at valuation, or when we're looking at building a company or building a business which we want to sell, we would want to make sure that the financial performance of the company, or the financial record keeping, or when we talk about the financial reporting system, so it's not just the reports which look at the past, but also future. So like your budget, your cash flow projections and things like that, that'll have a huge impact on how your business is valued. So I hope that makes sense. And if you have any questions, pop it in the question chat box and I'll come back to you. The second driver straight up is growth potential. Now, when we look at growth potential, what it means is to what degree, is it possible for your business to grow quickly, for that matter. And that is why we call it growth potential. It is the second of the 8 driver. And when we look at growth potential, I'm sure some of you know this guy, Rod Dury. If you don't, he's the guy who was behind Xero, the accounting software. So he's known for that. But some of you will know him from Xero. But what most of you would not know, that before Xero, Rod built a company called Aftermail. And he got the funds from Aftermail to build zero. So it's a successful sale of Aftermail. So what does Aftermail do? Aftermail was born after, at the time of Sarbanes-Oxley legislation in US, where all these giant companies, the Fortune 500 companies, the bigger companies, had to do a better job of archiving their mail and their communications. And what Rod did is create this product called Aftermail, which enables us to archive and gives you access when you need it on demand for all your old messages. Virtually every Fortune 500 company, every large enterprise company, as a result of Sarbanes-Oxley legislation, needed some solution to do this. So Rod went about and sold to 2 Fortune 500 companies on this idea. He got 2 contracts, each around 1 million. So he had about $2 million in revenue. He had what software people call product market fit, if you understand what I mean. Now, what would 99% of entrepreneurs do at that point? They would hit the gas, they would put the marketing out, and they would try and sell it to more people. I've got 2 out of these 500. Let's get another 498. Let's sell this product or service to them. To Rod's credit, he did not do that. He said, who else would want to buy this company? What is the care.com of my industry? Well, it was a company called Quest, and Quest was a software reseller of sorts, and they had relationship with all or most of these Fortune 500 companies because they sold them software. Rod said, look, all the Fortune 500 companies you sell software to need my product. We could go compete with you in Coke, Pepsi battle for next 10 years, but I've already built this product. So why don't you just buy my company? So Rod Dury sold Aftermail, a company with $2 million turnover, for $35 million. Now, is that possible in your situation? I have no idea. But I do know it would never have happened had Rod not made the case about the growth potential of his company and what his business was worth in Quest Software's hands. Not what is it worth for him, but what is it worth for Quest. And that's the definition of strategic acquisition. By the way, when a strategic acquirer has some asset that they bring to bear, in this case, Quest had assets, which was like 400, 500 relationships with these big companies. And that was an asset which made Rod's company more valuable in their hand, which led them to such an outlandish offer. That's what calls growth potential. As much as you want to celebrate your wins to date, celebrate how much revenue you generate, how much profit you have, remember that acquirers value those things, but what they value more is the potential of the company, what they can do with it in future. If your business can grow quickly in their hands, they're going to value your company much more favorably than otherwise. So growth potential comes down to identifying few things in your business. And those few things are basically, when we look at it, one, whether whatever you do, it is teachable. Second is, how much of value is it to your customers or how differentiated it is. And thirdly, how repeatable this whole process is. So it's important for you to kind of assess what you do and how do you benchmark on these criteria or these parameters. So let's look at all your software, all your products and services and see how you do that. So let's take an example here. So let's talk about photography. So there's a particular company based in Danbury, England, which started the photography business. And when they started the photography business, they went about looking at different ways or different options of photography. I mean, photography is a wide industry, isn't it? You can take weddings, for example. You can say, OK, how teachable wedding photography is. Can I teach a young person how to shoot? Well, it's not that complicated because you can, if you master a few things, you get the few shots, you can teach somebody how to shoot weddings. Second thing that which was important was, how much of value it is. Obviously, somebody is getting married, and as long as you're an expert or you specialize in wedding photography, it is a differentiated product. But one problem which was, it's repeatable. Now, unless you're a big celebrity or you're getting married a few times in your lifetime, it's not really repeatable. So that's where the score goes down in this case. And then they looked at another option, which is the sports photography or football photography. And they were looking at, different options and saying, OK, what can we do here? So in case of sports, obviously, when we look at sports, it's not that complicated. You can teach somebody how to, take nice pictures of people playing sport. The important thing which they looked at was the valuable, how important it is for people and how much would they be willing to pay for sports photography in school or in games that they play for that matter. Now, few pictures are good, but people wouldn't be willing to pay for a lot of pictures unless you're a professional footballer. And in terms of repeatable score, when you're looking at it, yes, there are lots of football matches, so it's repeatable. So the score for wedding is 16, and let's say for sports photography or football photography is 21. And then they looked at another option, which was to look at the school photos. Now, what happens in school photographs is, look at how often do schools take the photographs, first of all. And secondly, how much is of value to people and how teachable it is. Now, when we look at school photography, one thing which you need to understand is, in terms of teachability is, yes, the different aspects of school photography. One thing we need to understand is who's paying for the school photographs. It's not the parents. It's the school head teacher normally who pays for the photographs or who gets the photographer in. So in this case, what they said, yeah, we can work out a process where we can get kids in and out of the auditorium quickly. We can, kind of work on give them some toys, tell some jokes, get them to smile or laugh when it is important. And all together, we can create a process where we can get these photographs done quickly and efficiently. Now, as a head teacher, this is really important because what you don't want is that, you don't want the kids to be goofing around just because it's a photograph day. And because a head teacher is the decision maker, they want it to be very efficient. Now, if you look at differentiated, now, is it important or is it differentiated enough for the head teacher or the school? What do they care about? They care about learning. They care about keeping record year after year, because that's sort of their KPI. There's kids coming in and leaving the school. And repeatable, yes, because they do these photographs on a regular basis. So the score is 27 in that case. And that's how they founded this company called School Photographs, schoolphotographs.co.uk. All they do is school photographs, and they've scaled up because focusing on one offering has allowed them to teach employees to deliver a repeatable service which customers value, coming from the school photograph company. Now, so when we look at this in this case, what they have done is they've plotted it on this scale here, differentiated versus teachability. So what we are looking at is something which is differentiated as well as teachable, for it to work, for it to be important. And when we look at this, the challenge is things that are differentiated or very differentiated or valuable are difficult to teach, or the other way around. Things that are easy to teach are not really valued, or that may not be very differentiated for business owners. So it's important to get that right balance here. Now, if it was easy, more people would do it. So what I would like to share with you, my advice is that, it is easier to take what is teachable and then add a layer of differentiation to make it valuable, rather than the other way around. Let me say it again. It's easier to take something that is highly teachable and add a layer of differentiation to make it valuable than it is to do the opposite. So it's important for you to understand that. And just to explain that, let me share an example with you. A gentleman called Darren Root, and what he was doing was he ran an accounting firm, and like most accounting firm, he did a bit of merger and acquisition, corporate finance, which was valuable, yes, to SMEs, but it was not really teachable because, it takes years to become an M&A professional, not something you can teach a bookkeeper. He did a bit of technology consulting, he did a bit of audit work, which was again, not so differentiated, but somewhat teachable. And then he had whole series of things here, which were, highly teachable, but not very differentiated. Those were the things that a bookkeeper could do: payroll, daily deposit, reconciling, monthly financial statements, and things like that. I mean, it's all bread and butter stuff for most bookkeepers, right? Yet they are not very valuable in the eyes of the customers because they're just like commodities. Any bookkeeper could do those services. So what Darren did, he took those highly teachable products and made it into a bundle and created a company called BOSS. Look at the acronym, Back Office Support System. So what he did was he created BOSS system, Back Office Support System, which kind of focused in this specific niche. And he focused on just a few target markets. He focused on medical practitioners, he focused on doctors, dentists, physiotherapists, chiropractors, people who didn't want a full-time office manager to do the back office work. They would much rather pay £1,000 or £500 for Darren to supply the entire BOSS system and avoid hiring a full-time employee. Now, if you bundle all of this together, when you bundle all of this together, this kind of becomes differentiated. It's not a commodity anymore, because when you look at it from the perspective of the business owner who's paying for it, they are saving a full-time wage for them to be able to use BOSS. So in that case, it is branded differently and it is differentiated, right? So they take a suite of teachable products, bundle them together and make it unique, and then kind of put a branding on top of it. And that is what Darren did. And that's how he was able to then build something on top of it. So that's an example which I'm sharing with you. So this is one of the ways. So what I would suggest is take a piece of paper, write down the products or services that you have, and give yourself a score out of 10 in terms of whether they are teachable, whether they're differentiated, whether they're repeatable, and do a total, on the right-hand column. So if you do that, you can sort of start looking at your product mix or your service mix and say, okay, what is it that we need to be focusing more on? What is more scalable? And what do we need to do to make it more differentiated? If it is teachable, can we do something about making it more differentiated or making it more valuable? So these are some of the questions you could ask. So this is an exercise, you can do it in your own time. So this is the template which you can use to complete that exercise. Right? The next driver that I will talk to you about, the third one, is the Switzerland structure. Now, as you know, it comes from country Switzerland, which is obsessed with independence. Switzerland didn't join the war, didn't send troops to Iraq, and also doesn't use the euro. The concept, the Switzerland structure, which basically means that you build a company that is not dependent on one employee or one customer or one supplier. So that's what is important. Now, if you go back to the first driver, remember we talked when we looked at the discounted cash flow. You remember acquires value or care about the reliability of your profit, and anything that compromises the reliability of your profit stream will discount the value of your business. So a big customer could leave, a major supplier can change their terms, a key employee could hold you ransom, and all of this will undermine your score on Switzerland structure. So it's important for you to sort of look at or analyze how dependent you are on any one big customer, any supplier, or for that matter, any employee. So just to share an example here, Jean-Eric Plamondon founded Prairie Metal Recycling, a mobile scrap metal company that used advanced machinery to provide scrap metal cleanup services to farms in Canadian Prairie. Now, as John Eric grew the business to a revenue of 5 million, when he started to notice there were some risks attached to the business model. First, he was dependent on one major client who was purchasing his collected metal, meaning he had very little leverage with that person. And if a client faces a challenge, that'll have a direct impact on his business. And second, John Eric relied on one key employee who ended up taking off all the trade secrets, half of his employees, the company's contacts list to start an identical company. So what he did, he learned from his mistakes and applying the concept of Switzerland structure, learning from the incident, John Eric restructured his company and kind of, built a company, which then again started again and learning from his mistake, where he's able to diversify his customer base, his supplier resources, and also position himself for a successful exit. So what I would suggest in this case is to take a minute, and this is something which we're going to stop here for a minute here. Take a piece of paper, write down the names of your employees, rank them. If you have 20 employees, rank them. So write the first one, the one on top, the one employee you would be most disappointed to lose. And down to the 20th one where you should have fired actually a few weeks ago anyway. So let's take a minute and put some names there to see how dependent you are on particular employees or employee for that matter. And you can do the similar exercise for your suppliers and for your customers as well. But let's take a minute, write down a few names that come to your head. Who do you rely on? So I'm going to give you a second to write down the names of the people who you think you rely on, and the business will suffer if they leave you suddenly. Right? So I'm going to give you a few seconds. Just write that down. And you know what you need to do. And then what I would also like you to do is to look at or share some ideas on what do you do to retain the employees, your key employees in your business. So for that matter, what do you do to retain key employees in your business? So now it's time to pick up your phone, a Menti, go there, share with me some ideas or share with everybody some ideas. What is it that you do in your business to retain some key employees in your business? So what is it that you do? So do you give them some incentives, or are they on a shares scheme, or what are you doing for kind of keeping them in the business? So bonus scheme, salary incentives, yeah, good one. What else? Treat as human, that's a good one. Profit share, remuneration, responsibility, happy working environment, good one. Company culture, free time incentives, that's a good one. Develop their skill, promotion, great place to work. Training, that's a good one. Vision, yeah, vision, that's really important. Treat well. There's some really good ideas here, and as you can see, some of them are more common than others, but sometimes common sense is not the most common thing. So if you're looking at some of these ideas here, I would like you to sort of think about how effectively, if you're implementing some of these, how effectively are you implementing them? Because it's not just about having this idea and implementing it. It needs to be implemented effectively. It needs to have an impact, or it needs to serve its purpose for that matter. So yeah, thank you for sharing. Culture is the key. Self-growth, good ones. Yeah, vision, mission, values, purpose. We talked about in our modules. If you remember that, it's important to sort of create that environment for them. Okay, thank you for sharing. So next driver is valuation seesaw. So what is valuation seesaw? Now, I'm sure you've sat on a seesaw before, and you know how seesaw works. One side goes up, the other side goes down. So when you're looking at selling your company, most of the time what happens when you're trying to sell your company, and if a buyer wants to buy the company, they will write a check, to the owner, right? And we would want, if we are selling the company, we would want that check to be big with as many zeros possible on it, because that's in our interest. And that's a great thing for SME because you get the value for your business. But the hidden thing when it comes to value of the company is that actually the acquirer writes 2 checks, not just 1 check. Not just 1 check, they write 2 checks. The second check is to your company, and the second check is to fund what is called the working capital effectively. It is the cash your company needs to continue to meet its immediate obligation the day the new person takes over. So here's the thing. Both the checks, the one to you, the owner, as well as the other one to the company, are drawn on the same bank account. The acquirer writes on the same checkbook, and therefore bigger the check they need to write to your company to fund its working capital, the less money is left over for you. And you can think of it like a seesaw for that matter. Like I said, if the heavier kid sits on the seesaw, the lighter kid goes up. So more cash your company needs to operate, lower the value of your company. Equally, the less cash your business needs to operate, higher the value of your business, because they're interrelated. So it's important for you to figure out or keep an eye on the working capital. And if you keep that understanding clear, you will also know that if your business needs a lot of cash or huge working capital, anybody who wants to invest in that will have to kind of dig deeper into the pocket to take it further. So this is an example of Grasshopper. So basically, David, what he did was he founded this company in 2004. It's basically about virtual communication system for entrepreneurs. Over the course of about 12 years, he grew Grasshopper without any outside investment because they had positive cash flow to fund their growth. Which is rare, but they did it. A fast-growing company with their own cash flow, it's rare, but they did it. And by the time Grasshopper was up about 30 million in revenue, Citrix, the industry giant, offered almost 6 times Grasshopper's top-line revenue with very few strings attached. The key was the positive cash flow. And because he didn't have to borrow, Citrix didn't have to put more money in the business because they had enough cash flow in the business, and $30 million of revenue, they sold for about $165 million of cash. So it's important for you to kind of think about your cash flow or your operating cash flow and how much money is stuck either in inventory or in receivables or in terms of the cash gap, and what is it that you're doing to kind of avoid that. So it's important to sort of keep an eye on that while we're doing this, because the valuation of your business depends on that. So when we look at this, and we've done this exercise in past, I'm sure you've seen me talk about it. Think about the ideas for getting your customers to pay money sooner to you. And also at the same time, think about the ideas, how you can take more time to pay your suppliers. So if you look at it from that perspective, it's important to sort of keep an eye on the ball in both the cases. Are we paying too sooner, or are we getting paid late? Excuse me. So I want to hear from you in this case. What are the ideas? Can you share some ideas on how we can get paid sooner? And we've covered this, we've done this exercise before, but I want to get some ideas now. What are you doing in your business or your organization which helps you get paid faster or sooner? So go on the Menti and please share some ideas with me in terms of what are the things you could be doing to get paid sooner? Give some discounts. Yeah, really good. Prepayment discount. Value add to service. Yeah. Retainer, that's a good one as well. Early settlement. Yeah, a discount. Make condition of serving. Yeah, make sure you position it properly. Make sure you tell them beforehand. Make sure you remind them of the timelines. Withhold delivery of goods. That's a good one. Reduce payment terms. Yeah, instead of 30 days, make it 15 days or 1 week, depending on wherever, whatever industry you are in, whatever will work. 50% upfront fee. Yeah, that's a good one again, because 50% upfront fee will help you cover a lot of the costs which are going to be invested. And if it's not a cost of product, it can also be the cost of labor, because more often than not, you will see you have to pay wages before you recover the money from your client. Yeah, take deposit, early settlement. What else? Keep going, guys. If you have some good suggestions, a good idea, share here. Charge a month in advance. Yeah, always the good idea. What else? Retainer, we talked about. Split projects up. Yeah, that's a good one. Invoice on time. Make sure you invoice on time. But most people don't get paid on time because they don't invoice on time. I've seen a lot of clients make that mistake. They don't invoice on time. So make sure you invoice on time. Ask for deposit, agreeable payment terms. What else? Deliver quicker. Yeah, finish the projects quicker. If you're getting paid on some milestones, make sure you achieve those milestones or incentivize those milestones within your team as well. So it's important to sort of look at that. So yeah, some really, really good ideas. But I want you to think about these two things. How can we get money faster, and how can we slow down our payments or outgoings within reason? Of course, you don't want to be delaying payments to other people, because at the end of the day, their business needs to be run efficiently as well. But don't pay tomorrow if your payment terms are 30 days. So you have enough time to pay, unless you're sitting on a big chunk of cash and you would rather. Because I've seen some business owners who, as soon as they get an invoice, they make the payment. And as long as you have extra cash, it works fine. But if you don't have cash, then I would like you to think about it and say, okay, what is it that we need to be doing? Okay, so good ideas. Thank you very much for sharing. Let's move on to driver number 5. And driver number 5 is recurring revenue. And we've talked about this recurring revenue, isn't it? So far, a couple of times we've already gone through it. But I want you to reiterate again that acquirers or a buyer value predictability and recurring revenue. There's nothing that makes your business more valuable than recurring revenue. So it's important for you to understand subscription model. We've talked about, some of these things in some of these sessions that we've had before, right? So when I say recurring revenue, what do you think of? When we look at recurring revenue, we think of, SaaS companies for that matter. When we're looking at recurring revenues, we are looking at software companies, membership websites. So most business owners think this doesn't apply to me because I'm a manufacturing company, or I'm a distribution company, or I'm a retail business. They think I don't have a recurring revenue. This is the concept for those lucky people who run SaaS companies. Well, I just want to share a story of H. Bloom with you. Now, H. Bloom was in retail business. They were in business of selling flowers. I know some of you know Sonu Panda and Brian. And you know about H. Bloom as well. Now, when they decided to reimagine the business of selling flowers into a subscription company, how did they do it? Well, they looked at the world and kind of started to sort of segment all the people who buy flowers. Now, when they started segmenting, they realized that the people need flowers for funeral, then they buy for graduation, they buy for different occasions. And they also realize that hotels buy flowers on regular occasions, especially 5-star, 4-star hotels, because they want to kind of, give impression to their client that, they're a fancy hotel. And as it turns out, 4 5-star hotels buy flowers regularly. But it's a hassle for the hotel manager to replace the flowers. Someone has to go down the flower store, stand in line, get a bouquet, bring it back. So Sonu and Brian built H. Bloom, a subscription company. A flower company based on subscription, sorry. And when you look at the average lifetime value of a flower store customer, typical transaction, average transaction would be about between 20 and 25 or 30 pounds. The average lifetime value of an H. Bloom subscriber is 4,500. Now, I want you to think about how that impacts your business model. All of a sudden, you can go from a retail store where the owner, as an owner, you can't really hire salespeople. You've got to be there 7 days a week, 12 hours a day, selling flowers, make one sale and, kind of wait for the customers. Whereas on the other hand, H. Bloom, they make one sale and they can guarantee 4,500 worth of revenue over its lifetime. all of a sudden you can project better. And what that would help you do is you will be able to afford to hire the salespeople, buy them a car, give them benefits, because you know every sale they make, they're going to bring 4,500 worth of business. That's a total game changer. So when Sonu and Brian were asked what's the best thing about having a revenue model, recurring revenue model, they didn't actually talk about the lifetime value. What they said was it is the predictability of their business. Because one of the things that the typical flower store has a problem with is inventory that goes bad. Imagine a farmer cutting flower, inventory in the fridge, then transportation, and then in your store, and it rots, and you've got to throw it out. Typical flower store throws almost about 50 to 60% of its inventory. Well, because H. Bloom only buys the flowers for their needs to fulfill the subscription they have, their spoilage rate is less than 2%. 60% versus 2%. Which company would you rather own? Which company would you find less stressful to run? And you may be thinking, well, I don't have the inventory. I don't have inventory that goes bad anyway, rots. But if you have people, you do have inventory. Your employees come Monday, Tuesday, and they would want a paycheck on Friday or at the end of the month, whether you have the work for them or not. You need to learn how to use your resources effectively, because then you will be able to predict better how many trucks on the road, how many people today, tomorrow, 3 months from now. And therefore, you can be more efficient, more profitable, and ultimately, you can build a business which is less stressful. So I'm a huge believer in this idea of recurring revenue, and I'm sharing this again. I've said it few times earlier as well. Most importantly, it is going to improve the value of your business. If you have recurring revenue, it's going to help you improve the value. Now, I want you to take a moment here and think, how much of your time is spent on firefighting versus how much of your time you spend on strategic planning on a day-to-day basis in your business? And if you're honest with yourself, you know the unpredictability causes the firefighting. And some of that unpredictability is bringing the value of your business down. So this is the secret to building the business, or a business which is valuable. In this case, Sonu and Brian identified a segment that had a recurring need for what they sold. And that's how they built their recurring revenue model. It was to address that segment's pain point, not to address all the customers' pain points. No, just focus on what is the most important one, right? So it's important for us to look at that. So let's take another example. Let's take another, business here where we can look at. So if you look at CCTV business or security business, they install the cameras, they do the wiring. So they've got some installation revenue. So they come, they install the stuff, and then they also have a recurring revenue or the subscription revenue. Now, a typical buyer is willing to pay about £750,000 for every £1 million of installation revenue. That's a fact, right? How much would they pay for monitoring or the recurring revenue business? That's a question to ask. So every time there is a comparison between installation, which is one-time revenue, versus the recurring revenue, they're willing to pay £2 million for every £1 million of the monitoring revenue, because it's coming again and again and again. Because it is worth almost 3 times because of the surety that it will come in. So more recurring revenue you have, the more your business is valued. Remember that. But also remember that not all recurring revenue is same. So if you want to learn more about recurring revenue, reach out separately and I'll share some ideas on what can you do in your business. So it's important for you to look at that. But remember, recurring revenue, subscription model, certainty is the key to improving the value of the business. So driver number 6. Monopoly control. I already talked about monopoly control when in the first example that I shared with you. Now, I also like to use Warren Buffett as an example, because Warren Buffett is a famous investor, and a lot of people follow what he does. Now, when he talks about investing, he talks about investing in companies with a deep and wide competitive moat. Moat which surrounds the forts or the castles and things like that for for the purpose of segregating it. So what he says, I look for companies with a deep and competitive moat, among other things, when I'm buying the company. Why does he care? Because marketing differentiation allows the business to some extent control the pricing, how much they charge. And we've talked about the pricing strategy in some of the sessions before, but if you can create that marketing differentiation, you can charge more. And if you can charge more, you can get better margins. And if you have better margin, you have more money for marketing. And if you have more money for marketing, you can widen that moat. So that's what basically this whole idea is about, making sure that you have marketing differentiation and kind of widen that moat. So what makes a great marketing strategy? The great marketing strategy has two attributes. One, it should have that your product is differentiated or valuable to the customer. And the second is that the customers need to care about whatever that value of differentiation is. It needs to be important for them. If you find an attribute which which makes you different from your competitor, but if the customer doesn't care, it doesn't help. At the same time, if customer cares about something, but all the other people are using the same differentiation, that also doesn't hold true. So in case for your marketing strategy to have some teeth, it's important for both these attributes to work together to make it unique. And that's what is important. So what happens in this case here, for example, when Panasonic came to the market and they were looking at positioning in the marketplace, they were saying, OK, what is already there in the marketplace, and how do we position ourselves in the marketplace? So when Panasonic came, they were thinking, and how are we going to position ourselves in the marketplace, because it's already very crowded. Apple owns Sexy, then Dell owns Direct, HP talks about innovative, and these are all the things that customers care about. But apart from Apple, others were there, they were talking, but they were not very differentiating at the same time. So what Panasonic did, Panasonic decided to choose tough. That was their positioning in the marketplace. Now, was it differentiating? Did customers care about? Not all the customers care about the tough product in the market, but there was one particular segment that did care about very durable laptops, and those are like police officers, army officers, people who have to do their job in a violent, often unsettling sort of environment. And therefore, the reliability of the product in difficult circumstances is a very important attribute for them. So highly different, yes, and their customers, and in this case, police and officers, the groups, it's very, very important. And they launched a very successful product called the Tough Book into those market segments. So that's how they kind of created that. So I would like you to think about your situation here. So think about what makes your product unique, and I would like you to do it separately for separate product categories. And how much does the customer care about that property of differentiation? So this is something which I would like you to think about. What makes you unique, and why would your customers care about it? And if you can get a good score on both of them, then it is worthwhile pursuing further. Otherwise, you need to go back and think about your positioning, how you're positioning yourself in the marketplace, what your branding is, or kind of how you're building your brand in the marketplace. So think about that for that matter. All right. So this is an exercise that you can do in your own time, and because this requires a bit of thinking time. Let's look at driver number 7. Driver number 7 is customer satisfaction. Now, customer satisfaction is important. Why? Because customer satisfaction is important because it gives some clues about the reliability of your future earnings or future profits, right? And the best way to do that is to look at how happy or how content or how excited your customers are to do business with you and come back to you again. But the problem with most of the customer satisfaction surveys is it's not predictive of anything. So you've heard about Net Promoter Score, right? When Reichelt, the guy who kind of created this Net Promoter Score, he did the research, and the questions, he was looking at the questions we normally ask. He figured out the questions that we ask in customer satisfaction do not predict much. So we ask questions like, how were you satisfied? How overall satisfied you were? Did your customer sales rep, serve you properly? Did you get your issue dealt within one call? None of these questions, when they asked, are predictive of the growth rate of the company. There was one question, however, that Reichel discovered is predictive of the future growth rate of the company. And it is why most acquirers use it to measure and evaluate potential acquisitions. The question is the underpinning of the Net Promoter Score methodology, and it is simply you measure the response of customers on a scale of 0 to 10 or 1 to 10. How likely are you to recommend us to a friend or a colleague? Once you ask that question, you can then bucket your respondents into 3 buckets. And these 3 buckets, you can look at the first bucket, the people who give you a score of 9 and 10. Those are the ones which are your promoters, who would actually recommend you. Then the second bunch, which is 7 and 8, which is, the kind of passives who in this example here is 70%. And the last one, anything below 7, between 0 and 6 are the detractors. And in this example, it's 5%, for example. So to calculate your Net Promoter Score, what you will do is you will disregard the 70%. What you will do is you will take promoters and subtract the detractors from that. So in this case, 25%, if you subtract 5%, gives you 20%. So it's a simplistic exercise, but this is an indication of how much your customers value doing business with you. If so, in this example here, you can see the Net Promoter Score is 20%. Now, when you look at UK, the average industry average normally is about 15%. So if it was 20% in the previous example, you'll still be better than UK average. Now, there are some examples here. What I would like you to sort of think about is what are you doing to measure your Net Promoter Score? Is there any way for you to work on that? And if you can do something about it, how aware your team members are, or how aware they are about this in terms of Net Promoter Score? Or are you doing do you measure anything, or do you compare it from one period to the other? And if you do, what actions you take? So it's important for you to kind of think about that. Okay, the last driver. How are we doing for time? Yeah, we are okay for time. So the last driver is hub and spoke. Now, hub and spoke is the final driver which measures the business dependence on owner, how much the business depends on its owner. Now, Switzerland structure we talked about, the company is dependent on employee, customer, supplier, but hub and spoke focuses on company's dependence on the SME owner themselves. Right, so that's what we're going to talk about. And while we're doing this, there is something also I want to share with you, which is called owner's trap. Now, what is an owner's trap? So when we look at owner's trap, as you start the business, or as you kind of grow the business, you are kind of an expert in your industry, isn't it? So if you sell products, if you sell services, if you're a car dealer for that matter, dental practice, whatever you do, you have industry experience. That's how you set up the business in first place. Now, in that case, what happens as you're growing, you probably do a lot of selling yourself. And as such, your customers want to deal with you. The challenge is that because you are so well versed in your products or your industry or the processes or systems, it makes it tempting for you to sell too many things. You can do this, you can sell that, you can sell that, because as an entrepreneur, you're looking for opportunities. And you know the capabilities and you can deliver things. So when you sell too many things, the problem is your employees can't keep up with that normally, right? And in that case, what happens, because your employees are not able to keep up, the customers who are dealing with your employees don't get the same experience as they do when they deal with you. That only reinforces the customer dependence on you personally, because they're like, well, you asked me to deal with an employee, but they don't know what they're doing when it comes to this product or service. So I want to deal with you. And the way you know you're in owner's trap is your business reaches a plateau, or your revenue slows down when you're not there, or things don't move when you're not there, or your customers want to deal with you, right? You've seen those signs. So if your customers know you by your first name, that's when you know you are in owner's trap. So in that case, what you need to do is if you want to get out of the owner's trap, you need to make a fundamental shift to how you do business. And what you need to do is you need to make sure that your business, when instead of selling a lot of things to a few customers, you need to focus on selling one thing to a lot of customers. And when you're looking at taking this approach, you are able to train your people better. You're able to create the systems, or you can create the processes better, and you can get more control and you can get more efficiencies in. So most valuable companies, they do this. Like Stephanie Breedlove, I gave you the example. They sell one thing to lots of customers instead of selling lots of things to few customers. Now, how many of you feel this, the signs that I've just shared with you, owner's trap? Firefighting, things don't happen without you, or things get stuck, or you think you're getting plateaued, or you think your employees are not kind of taking more responsibility. And these are all signs of owner's trap. Now, the worthless business, as you can see, is a business where everything depends on you. Because everybody wants to deal with you. Suppliers want to deal with you. Customers want to deal with you. And team members, they want to deal with you. Every time there's a problem, they come to you and say, this is the problem. What do you want me to do? So you have to give them the solution, and then they go and apply the solution. They don't actually use their own thinking hat and kind of come up with some solutions. So if the business is dependent on the owner, then it's an unsellable company. Because remember one thing, if somebody wants to come and buy a company, they won't be buying you, they're buying the business. But if you step aside, somebody else will have to fill those shoes. So most probably it's the acquirer. So effectively, an acquirer or a buyer is not buying a business. They're just buying another job. And if you ask yourself, how much would you be willing to pay to buy another job? Not a lot, So it's important for you to think about how dependent the business is on you, and what is it that you can do to make it less dependent on you. So let's do this exercise again. This is something which I would suggest you need to think about or work on. Think about what have you done in last 5 years to make your business less dependent on you personally. Right? What have you done? Think about it. And then write down a couple of things which you can do in next 90 days to make your business less dependent on you personally. So you may have done some things in past, and I know some examples. I've had some conversations with you where I know some of you have been working really actively on this. Is there anything else you can do in the next 90 days? Right? So I'll give you a minute to maybe think about it if you write down some things, and then I'll ask you to share them with me. So let's take a minute to write down a few things. What can you do? Or what have you done in past? Once you've done that, I would invite you to Menti and ask you to share. What are the things that you've done, or what are the things that you would like to do over next 90 days? So please share with me what are the things you could be doing or would like to do to make the business less dependent on you. Yes, automate. Yeah, that's a very good one. Really, really good one. Because automation takes the reliance from a person and puts it on the process or the system. Good one. Come on, guys, let's share. Invest in some training to pass the skill. Yes. If you are the smartest person in the room, you're in the wrong room. You've heard that, right? The same thing applies to the business. If you're the smartest person in the business, there is something wrong. Team empowerment, created and trained a senior leadership team. Very good. Delegate some management responsibility. Outsourcing, that's a good one as well. Document everything. Communicate strategy to company. Yeah. Hire ops person. Good one. Increase how-to packs. Yes. how to manuals, how to packs. Yeah, create processes. Sorry, I have jumped. Yeah, create processes, how to pack, make the team function correctly. And what else? Hire your replacement. What else? Come on, I'm sure you can have lots of ideas. What else? What else? Share some more ideas, because we are learning from each other as much as we're learning from this particular webinar. What else could you be doing differently? You know, look at succession planning. Look at the job profiles. Look at the organization structure. You know, transfer ownership. Yeah, that was a good one. What was that? Transfer ownership to team via trust. Yeah, that's a good one. Very good one. So yeah, what is this one here? Another one. People are typing. Some really good suggestions here. But I think, yeah, it's important for us to think about what could we do to remove reliance on from us to the other people. You know, and there's a very good book. I've recommended it to a few people. I'm sure you remember that. 1 Minute Manager Meets Monkey. I mean, I would suggest you look at that book or read that book or listen to that book. And you know, Turn the Ship Around is another one, which is again, you know, getting people to make decisions or own up the decisions. There are two really good books. Right. OK. Thank you for sharing that. OK. Next. Right. OK. So when we're looking at, you know, some of these specific actions that we could be using to take things forward, it's important for us to kind of look at what we need to do from here on. And I'm going to stop sharing my screen for a second so I can look at you. Yeah, so when we're looking at some of these things here, what I also want you to kind of think about is, you know, what is happening within the team, or what is happening within the circle of influence around you, and how you are kind of dealing with, you know, the transition, or if you're thinking about moving the business from one stage to the other, how does that transition work, and what role does the team play in this whole process? And one of the things that I want you to kind of remember while you're doing this exercise is to kind of take the team, or take the rest of the team with you while you're going through this process. It's not something that you can do on your own. So it's important to involve the rest of the team with you. But again, sharing information to what level you would do that, I leave that to you. But I think it's important for you to kind of take everybody along through this journey. OK, so one last thing that I want to share with you before I just start the questions is this one, which is the manager versus owner matrix. So and this is something which is important for you to look at. So when we look at the organization, what I want to sort of kind of share with you this concept, because a lot of entrepreneurs, we make a mistake of thinking like managers, and sometimes that works against with whatever you'd be doing. So let's start with how managers think. So typical manager becomes a manager. How do they become a manager? So if you think about it, most managers go to school, university, college, and then, you know, start looking at the language of management, start growing in the company, work for a company, start growing in the company, and ultimately they become a manager in that company. They rise through the ranks. And when they're rising through the ranks, they learn how to manage certain matrix, right? That's part of their job. Now, if you think about, you know, managers matrix, what they're looking for is they're interested in, for example, sales manager is interested in sales, the operations manager is interested in expenses, and so on and so forth. So it's general managers looking at the EBITDA. So all of these are managers matrix, which are important because at the end of the day, you remember the financial performance is important. But that's the language of management we learn in business. And that's how we hold managers accountable inside the companies, because we manage KPIs, right? But I want you to sort of remember, these are just the ingredients. As an entrepreneur, I would like you to sort of focus on what those ingredients make, not just about the ingredients. Managers care about the numbers because their bonus is triggered. But owners need to understand that these are ingredients, and what is important is what meal is created out of those ingredients, because that's the value of the business. So if you're a senior leadership team or the manager or owner, you need to be focused on the value, not just the ingredients. So think like a business owner, think like an entrepreneur, think less like a manager. And that is something which I want to sort of share with you. And when we're looking at this, one of the things which I want you to sort of remember, a simple matrix, profit times multiple gives you the value. And most of the time what we do is we work on growing the profit, and we grow the profit. Let's say in this case, we take the profit from 800,000 to 900,000. So the valuation of the business goes up. But when we start applying these 8 key drivers, so start working on these 8 key drivers, we are not only increasing the profit, but we're also increasing the multiple. And as you can see, the value of the business, the jump in the value of the business. So it's important. I want you to keep an eye on the value of the business. And that is how your business becomes 2 times, 3 times, 4 times, 5 times more valuable. So if you follow those principles, then you will be able to grow the business further. So these are the 8 things you need to focus on. Industry revenue are important, but that's not the only thing. Make sure selling less stuff to more people, make sure you reduce reliance on single customer, single employee, and single supplier, and focus on your net promoter score. Focus on your net promoter score and train your team to focus on net promoter score, and leave some field to plow for others. If anybody wants to buy your business, leave something for them. And lastly, focus on creating the revenue stream, recurring revenue stream. So when we're looking at this whole thing, if you follow these principles, you can actually get out of the owner's trap and truly build the value of your company. And you can look at the ultimate freedom. Now, you can build a business that can thrive without you. You hold all the cards because you can scale up, you can sell, you can pass down, or you can just hire another director who can run the business for you, and you can just be a strategic advisor and a chairman of the business. So that's more or less, what are the possibilities. And just to sort of share with you, in case you're wondering how you can get access to that, it's simple to do it. There is an assessment which I can share with you if you're interested. So which will give a score on each of these 8 key drivers, and you can see where your business is at and what is it that you need to do. So drop me an email if you want the assessment. I can share that assessment and kind of share it with you. And that way we can kind of work on it. And if you want to have a session, then I can work with you on some strategy. So there are different things which could be doing in each of these areas. There are things which are really, really common sense, but at the same time, they're not so common, commonly applied. So there's a lot of room for us to work with. So that's it from my side. I'm going to now bring you all in and answer any questions you may have. So we've got about 7 minutes. So let's look at the questions. Anybody would like to ask a question? Raise your hand and I will unmute you, and then we can have a quick question and answer session. Kirti, are there any questions in the chat box? Which Rob? Yes, go on, Rob.
Hi, Andy.
Hi.
So NPS is something which I'm aware of, and what I've been struggling with though is finding a tool which is appropriate for an SME like ourselves. The ones I've seen are really kind of enterprise kind of orientated. So is there anything that you know of that you could recommend? Yeah,
there are 2 or 3 options. What I'll do is I'll drop you an email on that, Rob. I'll send you the link and I can share them with you. Because most of these NPS tools, they're designed for bigger companies.
Yeah.
And because and that's the problem with SMEs. Sometimes there is a tool, but it can't really be applied to SMEs straight away. But there are a couple of websites which have that tool which can be used by SMEs. So I can share them with you if that's okay.
Thanks. Yeah, that'd be great.
Yeah. Has anybody else done their NPS score or some sort of an assessment on that? Anybody? Do they know what is your net promoter score? No. So I think it's a good starting point to ask, do a survey with your current client base and say, would you be happy? So anytime you do a client satisfaction survey, add this question. How likely are you to recommend us to your friends, family, or your circle? And it needs to become a standard part of any feedback exercise with any of the customers. Is there anything else in the chat box, Kirti? Anybody else raised hands?
Yeah, Andy, I've got a question.
Greg, yes. Yeah, Greg.
Hello, mate. How are you?
Yeah, mate. Yeah, I can hear you. Go on.
Just a question. When you're asking for these feedback, feedback from customers, if you're sort of dealing with sort of general public and consumers, it's much easier to ask those sorts of questions like, would you recommend to friends and family? If you're dealing more sort of business to business and you've got sort of a smaller client base, how would you go about trying to garner that information? Say you've only got, half a dozen clients or something like that, and you've got one key point at each of those clients. How would you try and get that sort of information?
Well, so I think when we're looking at the question, when we're asking something like, would you recommend us to friend and family, that's more like a retail or a B2C sort of an approach. But in a B2B approach, it'll be more like, would you recommend us to your customers, or would you recommend us to your suppliers? So depending on the industry, or depending on whosoever your target market may be. You can ask a question around that. But if you have a really small customer base for that matter, I would suggest then going back and looking at doing some segmentation again, and then asking the relevant question, Greg, because sometimes when we're looking at situations like these, or when we're analyzing things here, we may have missed something, because who else would value our product or service? If you have only 6 of them, then I would really look at kind of, having a conversation maybe around, rather than asking these people in a survey or something more like a one-to-one conversation with people as to, would you recommend, or have you recommended, or what sort of referrals you're getting from them. So that would be sort of my approach on that, Greg.
Okay, perfect. Thanks very much.
Thank you, Greg. Anybody else has any other question? Yes, Mark, you're on mute.
Hi, Andy. Everybody wants to know if you can send the slides and the recordings after the session. Yeah,
I'll share the recording. Mark, do you have a question?
It was just a point for the last query, really, that we have a system whereby we always ask for a referral from a prospect who says, no, yeah, we haven't got business for you at the moment, or we can't deal with you at the moment. We always ask that question. And it's amazing how many people say, well, actually, we've enjoyed the conversation, and yeah, you could try this guy or this person in the business. So I think referrals at every stage is a really good sort of discipline to have.
Yeah, that's a really good one. Thanks, Mark. And if people are referring to you, then obviously they're talking about you and they're happy to refer. That means your net promoter score is really high in that case. So yeah, making a habit of asking for referrals. So who do you know who would benefit from having a conversation? Who do you know? So whatever the pain point is, who do you know who would benefit from solving this problem? That if that sort of a question may be really helpful to ask in terms of referral. And if you're getting referrals, then great. Anybody else has any other questions? Or any other comment based on the questions that has been asked? If anybody would like to add to answers to Greg's or Rob's or anything else? No? Okay, and if there's nothing else, so just the last steps. If you need this score for yourself, or if you want to do this exercise for yourself, drop me an email. I've given you the email ID, so you can drop me an email and I'll set it up for you, and we can have a short discussion and take it forward. Before we wind up, the last thing that I want to do is hear from you what your key takeaways are or key action points are. So I would request everybody to sort of share whatever their key takeaways or their key action points are. So go to Menti and please share what your key takeaways are. I'm going to bring it on the screen here now so we can all see. It's important because that's a commitment to yourself. You're not committing to me, you're committing to yourself as to what is it that you're going to be doing in future. So 90 days challenge, that's a good one. Get out of owner's trap. Yeah, good one. Very good. What else? You can either type in the chat box or just use menti.com and type here so everybody can see here as well. So either way. Yeah, I'm going to type the email ID here so we can all see here. But yeah, please share on the screen whatever your action point is, because this you're telling your subconscious mind what you need to be working on. And if you type it here, the chances of you getting to it are much higher rather than just keeping it in your head. I think that's the email ID. businesscircle.co.uk. Yeah, so looking to scale, simplify sale processes, selling less to more. That's very, very important one. So look at all your product portfolio, all the products and services, and see which are the key ones, which are the really important ones, and what do we need to focus on. Rather than selling a lot, sell less to lots of people. Diversify offering, outsourced, reduce dependency on me. Good one. I've only got 8 people sharing here. What about the others? You don't have any action points or any takeaways. Come on, everybody, please share at least 1 or 2 things, because this is for you, not for me. This is for you to work on. And this is what the commitment that you're making to yourself. Ensure all employees buy into business tone of voice. That's a good one. Embed all key relationships as deep in business structure as possible. That's a really good one as well. On Menti, screen has frozen. Is it? Okay, let's see what has happened here. Yeah, okay, it's working now. So allocate some jobs, get out of owner's trap, like I said. Owner's trap. Yeah, I mean, look, if you're spending a lot of time doing firefighting, that is on typical, sign of an owner's trap. If everybody wants you to make decisions or everybody asks you, then obviously you're in the owner's trap. So it's important to sort of get out of that owner's trap and focus on what is it that you need to be doing differently from here on. Right. That's it from my side. If there is anything else before we need to cover, otherwise, it's really good. It was really good to see all of you. I know I've been touching base with you after a long time. It's really good to see, and I'm looking forward to seeing you on 11th. Most of you should be there and catch up. We can, have a beer together or maybe do some things together. But yeah, I'm really looking forward to seeing you on 11th as well. All right, so with that, I'll let you go. Have a good evening, and yeah, get on with implementing some of these things. Take care.
Thank you, Andy. Much appreciated.
Bye bye.
Cheers.
Thanks. Bye.